Hello and welcome to On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're going to be focusing on an asset that's been performing very well over the past 18 months or so. That asset is gold. Now, gold does tend to divide opinion, and some people regard it as a bit of a Marmite investment. So on the one hand, a lot of commentators would argue that a small weight into gold is beneficial over the long term as a portfolio diversifier, due to its ability to act as a safe haven in troubled times. Now, on the other hand, some commentators argue that gold, it does tend to be volatile and it also doesn't pay a dividend. Joining me to discuss this topic is Georges Lequime, a fund manager at Amati Global Investors. George is fund manager of the WS Amati Strategic Metals Fund. George, to start off with, could you explain in more detail what the pros and cons are of gold and why the precious metal tends to do well when other assets are not doing well?
Yes, certainly. Like you say, it's pretty Marmite gold. They call it the emotive metal. Everyone's got an opinion. Probably those listeners today or listening to the podcast, you'd have 20% would be very anti-gold, 20 would be pro, and probably the other 60% pretty curious because it's done really well. I wanted to start today just looking back at some comments that JP Morgan said in the 1912 testimony. And I quote him directly here, and that's why I brought my card, just so I don't get the quote wrong. Money is gold, nothing else. Gold, unlike credit, is not dependent on a third party coming through. Credit is only as good as the character of the borrower. And I brought those quotes because it's pertinent today more than ever, given what's going on in the world right now. So everyone's got an opinion, as you say. I've been doing this 31 years, and I started listing the pros and cons of gold. And quite interestingly, the list is about the same. That probably explains why it's so divisive. So obviously on the pro side, it's got a very long history of being a beneficial asset, as you mentioned, in times of uncertainty. If you look at how you want to protect your wealth, you can buy stocks, bonds, property, or hard assets. So it's always a play between those. And again, gold being highly liquid, it's also got a high value in a small volume. So a 400 troy ounce bar of gold, that's about 12.4 kilograms. Last week, it actually hit 1 million pounds, the value of one bar of gold. Now, one bar or the same weight in copper, the value at the moment is around $100 or 100 pounds for that same weight. So you can see the amount of value that you can attract. It's also very rare. There's only been, since the start of mankind that we know, about 212,000 tons of gold being dug out of the ground. It's in the ground. You find it normally in parts per million. Mines are mining at 1 or 2 parts per million. So it's very difficult to get out of the ground, first of all. And the amount of new production is around 1.5% per year. So just think about how much gold since antiquity we've mined out of the ground. It's about 22 meter cube, or 3 Olympic swimming pools. So it's actually quite rare and precious. And the other pro is that the government can't really trace it or tax it. Now, the World Gold Council did a report in January looking at the performance of gold in one's portfolio relative to other assets. So they looked at cash in US dollars, treasuries, global stocks, US stocks, emerging market stocks, commodities, and gold. And gold actually was the second best performer. So obviously in a 1 year, it will look very good, but this is on a 20-year annualized return of about 9.4%. So love it or hate it, the only category that actually beat gold was US stocks at 10.4%. But if you held it in US treasuries, you get about 2.58%, or in US cash, 1.65%. So it actually, over a longer period, and it's less volatile as well. So they did a survey of looking at portfolios with 5% gold in it and 0 gold. And they found those portfolios with 5% gold actually outperformed and were less volatile. So you can see the argument why portfolio managers in times of uncertainty say, okay, we're going to put some gold in the... And the last pro is if you're sitting in countries like Turkey or China, where you've had big currency devaluations, it's actually protected your wealth of being able to buy gold and then sell and get back into yuan or any other currencies.
And what's your thoughts on the arguments against gold? I mean, the two most common ones that I hear are that it tends to be volatile over the short term and the price of gold only reflects what the next buyer will pay for it. And also the fact that gold doesn't have a yield, which again makes it difficult to value.
You're dead right, Carl. So I've got a love-hate relationship with gold because I look at the cons as well. It's actually a useless asset if you think about it. It's parts per million in the ground. You dig it out, then you find a hole or find a safe place and put it away. It doesn't give you a yield, like I say. There's some use of gold for jewelry or some technology, and it can be volatile, you say. The other big con, I think, is it's a bit of a lottery where gold has been deposited. It prejudices those countries where there's no gold in the ground because it's basically digging money out of the ground. And in some countries where you do find gold, it can cause quite enormous social upheavals. And we saw with the Spanish conquistadors what they did in Latin America and Central America in search of gold and silver. And then you've got the issue of storing it. You've got to find a vault, you've got to protect it, there's a cost of storing it, and also to move it around the world. And also we saw in the US in the 1930s, gold was actually confiscated. So there's a bit of confiscation risk, and I'll get to that if you're looking at against holding gold equities as opposed to the physical metal.
We've seen over the past 18 months or so, it's been a very strong period for gold. Could you explain what the catalyst was around 18 months ago for gold to go on this strong run?
There's a couple of factors that turned around. I think for the last 14 years, we've had central banks become net buyers of gold. Now, if you look once the US dollar came off the gold standard in 1971, through the 1970s, typically as a percentage of foreign exchange reserves, gold made up 55%. Until the peak in 1980-81. And then other asset classes did very well. And as a percentage, that dwindled all the way down until about 10, 15 years ago to around about below 15% of foreign exchange reserves. What's been happening now is post-COVID, we had a reduction in interest rates, which again, it's not, the increase in interest rates that came after COVID meant that you got a real yield while inflation was coming down. So gold not offering you a yield actually performs badly in that period. So you had a lot of ETF selling. And that sort of terminated around about 18 months ago. But all the while, the structural support for gold was there from central banks. And then you had a third dimension that came in place about 18 months ago, where you had heightened geopolitical risk. And there was talk of maybe confiscating treasuries held by the Russians in Brussels, for example, and for central banks around the world saying, okay, we are now holding, they got up to 35% of US treasuries were held by foreign central banks, and that started to turn down and quite aggressively. So you've had countries like China saying, we don't like the way you're weaponizing the US dollar, and getting a more even balance on their foreign exchange reserve. So that's really what's been taking place. So, and then at the same time, you've had interest rates start coming down. So you've had investors coming back into gold.
So the increase in geopolitical tensions, that has caused central banks to act by increasing their exposure to gold?
Definitely. If you look at where the big growth markets are, India, China, the Middle East, there's definitely been a concern that maybe our weighting in US treasuries is quite large. We've seen global debt, especially debt in the US, increasing at a phenomenal rate. And central bankers, they've been acting on that for a while now and saying that. And the real turning point was the 2008, the great financial crisis. Then we saw central bank being a bit more prudent and saying, let's hold a little bit more gold in our portfolio.
And we've seen so far in 2025 that the gold price has continued to rise. How much of a catalyst has it been, the uncertainty that we've seen in stock markets since around mid-February due to US President Donald Trump's tariff policies?
It's a good question, Carl, because that's why I mentioned about should you be buying stocks or bonds or property or holding some gold or commodities in your portfolio. And the rollout of the tariffs really shook the financial outlook and the economic outlook for a number of countries. So the markets hate uncertainty. So gold as a safe haven attracts some buying there. But I think there's been a bit more than that, where especially the tariff war with China, which is headlined, has almost morphed into an economic war taking place between the Trump administration and China. And we've seen reports of China more aggressively trying to buy gold. They hold, the March figures came out, they hold 6.5% of their foreign exchange in gold. So it's still a small fraction from 2% a few years ago. So they've been building up. But I hear from the gold traders, China's got a problem trying to access enough gold to make it more 30 or 40%, which is the norm in Europe. So they've been aggressively buying gold and selling treasuries and buying euros as well. So you've had that trade taking place, and that's what's accelerated this move that you've had in gold.
And the gold price typically has an inverse relationship with the US dollar. So when the US dollar is weak, it tends to benefit gold.
Yeah.
So has that been a factor then at play over the past couple of months?
It has. The US dollar's only started to weaken in the past month, but you see it on a day by day. The days where the dollar's slightly strong, the gold price is off a bit, as you saw on Friday and today. But those are smaller moves. But I think in the long run, it's definitely you see these longer term patterns. A weaker dollar usually translates to a high gold price. The problem we have today is a number of investors are sitting and saying, we got 3,300 on our screens. There's a lot of tailwinds, but are we peaking here? And that's another question as well.
And how would you answer that question then? You mentioned, in US dollar terms, the gold price around 3,300. It was around 2,000 at the end of 2023. So how much higher could the gold price go? And is it potentially already in a bubble?
After doing this for so long, it's a bit of a mug's game to try and predict but I think it works two ways as well, because nobody wants to venture out and try to predict where the gold price is going. So when we look at our investments and the way we look at the companies and say, what are they discounting in the valuation of the companies? Because the brokers who write the research report and advise clients on the valuations of gold mining companies, they tend to be very conservative. I had a report out this morning from Peel Hunt, for example, and they were predicting a gold price of 2,181 in 2028. That's 35% lower than we are today. And in that research report, they said this gold silver company is at fair value. So I think if you look at it on a chart and you say discounted for inflation, the gold price is almost as high as we were in 1980. But then if you use monetary base as your denominator, then we've still got another 100% to move to get up to that level. So I think it does feel like there's a little bit of froth in the gold price right now. We're vulnerable to maybe some good news on a deal with China, or a resolution to the conflict in Ukraine that could take some of the hot money out of gold. But I do see that there's a structural trend upwards with a lot of tailwinds for gold that are not going away in the near term. So I'm hesitant to, I'll never put a figure on it, but I'm hesitant to be too bearish. I point to, and it's not only Peel Hunt, but a number of the brokers have got the same. I think on average, they're about 2,200 is the gold price that they use in their models. So they basically saying, we think the price is going to fall 30% from here, which is as dangerous, I think, as trying to predict it a bit higher. So it looks quite interesting. I think everybody's sitting on the sidelines waiting for a bit of a pullback to see where things settle before they look at it seriously as an investment. It just feels to me it moved too fast, too quickly.
And as you've mentioned, the big buyers of gold has been central banks. Retail investors have been buying, but I don't seem to get the impression that they've been piling into the market. Would you be more concerned of a potential bubble if that was the case, if a lot of retail investors were buying?
Definitely. I've been through 3 bubbles now, or 3 peaks in the gold price in my career. And if I look at the red flags, one has always been the retail buying aggressively. And then when you look at the stocks, the underlying stocks, they become really expensive. So the brokers move from predicting a big drop to predicting higher prices going forward. And right now you have stock valuations at 37-year lows. It's under-owned. In 2011, in the portfolio, there was on average about 14% gold as an ETF portfolio of global ETFs. Gold made up about 14%. Right now, we're at about 1 to 2%, which is an all-time low. So we don't have the investor positioning in gold that we had in 2011 when we peaked and we came back. And that's why I think you saw the other day when the stock markets came down, gold actually went up. Usually, that would be an asset class that would be sold in that same period. So it doesn't have all the ticks of this is bubble yet. I think usually what happens is you get that last wave when the retail investors come into physical gold. As an anecdote, a friend of mine in an office in New York, more technology office, and he's my age, and he's with a number of 30, 40, 35-year-old professionals in the office, and they told him a week ago, "Oh, we're starting to buy gold now." And he said, "What? I've been telling you for years." And he said, "No, but it wasn't right yet." And I think, we live in a bit of a bubble ourselves, looking at gold every day. But there are so many investors out there who've never looked at gold before, and they're starting to see the tailwinds and saying, "You know what? I need to protect my portfolio." So I think once we get that buying coming in, let's see.
I next wanted to ask you about gold's relationship with inflation. So gold, as well as being seen as a hedge against economic uncertainty, it's also widely viewed as an inflation hedge. Now, given the fact that some commentators think that inflation will be higher than what central bankers forecast at the start of this year, what are your views on inflation, its relationship with gold, and if inflation is higher than anticipated, that's surely a positive for gold?
The key relationship, I think, is really with the expansion in the monetary base rather than inflation. So yes, the two, even expansion in monetary base and inflation, are tied, because if not handled properly with increased money supply, that can debase your monetary system, causing inflation. That's basically you pumping too many dollars into a system, so prices go up, but you've just debased it. So we've looked very, very closely at the short and medium term relationship between the inflation figures that you get released and the actual gold price. and the correlation is not as close as you would think. But over time, definitely is, because inflation is tied again to the monetary base. So that's more important for us to look at and saying we've gone through a period now of quantitative tightening. That's slowing down. Quantitative easing obviously increases the monetary base and increases the monetary supply, which then leads to, as we saw during the COVID period, leads to high inflation. And that's just tied to the debasement of currencies. Because ultimately gold is a currency, and you're looking at the value of this currency against the dollar or the yen or the euro.
The fund that you manage, WS Amati Strategic Metals Funds, you have around 40% in gold. You invest in gold mining companies, which some commentators say are a leverage play on the bullion price. Firstly, I wanted to ask, is that fair? I have heard that said a couple of times over the years. Is it fair to say that gold mining companies do offer a leverage play?
Yeah, we have 40% exposed to gold mining companies. We don't have physical bullion at the moment. Actually, bullion has done very well against the gold mining companies since 2011 for a number of reasons. But we're starting to see that relationship turn. Historically, for every 1% move in the gold price, we'd get a 3% move in the gold equities. That's the leverage that you're talking about. Now, the average cost of production right now, if you really load it properly, is probably around $1,700 an ounce to produce an ounce of gold. And you're selling it for $3,300 today. But even if you're selling it at $2,500, you can see that margin. So the margin expansion from $2,500 to $3,300 is a doubling in the profit margin of the mining companies. That's why you buy the mining companies, because what's been happening now with this move in the last 18 months is a lot of mining companies are generating significant cash flow and paying down their debt and also spending more on exploration. So then if they can find in the vicinity of their mining operations more ounces at a cost of $50 or $100 an ounce, bring them to account at $3,300, that's where the value add. That's why you're buying the mining companies. Unfortunately, in 2011, the run up to 2011, a lot of the mining companies destroyed a lot of companies, a lot of value in that run up, and investors just sat back and said, we don't want to be buying gold mining companies. Their costs got too high, but I think this time around we've got a lot greater cost discipline. We've seen the oil price come down. That's giving them a boost on their cost. So it's wait and see. I think the more as we find a level on the gold price that the market can start trusting to be sustainable, and we need a few more quarters, I think then they'll start looking at the gold mining companies again. And as I said, historically, the gold mining companies used to trade on about 15 times cash flow at the bottom of the market and 25 at the top of the market. You look around today, companies are trading at 2 to 5 times cash flow. Yes, the gold miners have performed well year to date, about 45%, but they're coming off a very low base. And looking at the profitability, it's not reflected at all in the valuation of the companies. That's why we're holding that 40% in the portfolio right now.
And that 40% exposure, is that near a record high for the funds? What is your typical exposure?
Yeah, we group gold and silver exposure because most of the silver miners are 50% gold anyway. And that together is about 68, 69%. And that's the limit where we're going to. So we have a fund to invest across all the metals. You started by asking about the global uncertainty with the tariffs. That could lead to a recession in the US and Europe, which is typically negative for commodity prices like copper, zinc, aluminium. So we're a bit cautious that we could get a slowdown in demand just because of the impact of the tariffs. But then we've spoken about the positivities on the precious metal side, and that's why we're holding about 70%. So over the period, as we get that catch up on the valuations on the gold miners and the silver miners would then pivot the fund more into the industrial metals rather than the precious metals.
And could you talk us through the benefits of having a diversified portfolio of several metals rather than focusing on just gold or silver?
Yeah, that's something really occupied my mind, Carl, because I used to run gold funds in the past, and this fund really intrigued me, setting up a fund like this, because you would have a good run maybe for 2 or 3 years in the gold, and then typically you have the industrial metals follow through in the next wave. So it's very cyclical. And then you have the specialty metals, lithiums, the graphites, uranium as well. Those become really interesting. So it gives us the whole suite of metals to look at, especially in a period where the global economy is becoming more metals intensive, moving forward with the decarbonization trade taking place, with the infrastructure spend that needs to be spent. So all these factors are leading it. For example, we got a great gold mining, a company with a great gold project in Idaho, which has a large component of antimony. Antimony is used in the weapons section, and it's controlled by China. This would give the US a greater autonomy or a greater control on the supply of antimony, which is critical for their defense needs. So there again, we're able to look at these companies, and that's done very well for us. We've made almost 100% return on that investment.
You, of course, are an active fund manager. You invest in companies rather than the spot commodity price. Some investors prefer to own an index fund or an ETF, particularly an ETF, tracking the price of gold. What are your thoughts on investors going down that route, and could you make the case for active management over picking an ETF?
Over time, it's always shown that active managers outperform the passive, the ETFs. The first move is always to go into the big liquid ETFs, the passive funds. I'm looking at them now, and I'm looking at the components of that ETF. Some of those companies are pretty rich valuations. It's always the first stage going into the ETFs. The specialist gold funds, I think there's two problems here. One is that there's been a global shift into ETFs rather than actively managed portfolios in all the sectors. So especially in our sector, where I think being a specialist and being able to pick out the winners and losers can actually make you perform significantly better than the ETFs. But those active managers are not getting any inflows. So the companies that we look at, and we see fantastic valuations, until we get the generalist money coming into active funds, or they start moving down the food chain from the very large companies down to the medium cap and smaller cap, because that's where the really good value is. We've got a lot of companies trading at 0.1, 0.2 times net asset value, which we've never seen before. So it comes back to your question. I don't think we're in a bull market until that sector really pushes up. But it's really, you can look at the numbers, actively managed funds do over time way outperform passive funds. It may be not in the last 4 years, which has been quite disruptive while we've been at the bottom of the market.
And as you mentioned earlier, if you focus on one commodity, such as gold, then the performance, it goes in cycles. There are strong periods followed by more subdued periods. What would you say to try and convince an investor to think long-term and stick by a commodity such as gold rather than try and time the market?
The only way to do that is, bizarrely, you've got to look at that sector when it's out of favor and the valuations are as attractive as they are now. And then when it becomes in favor, then reduce that holding. But because each subset of the commodities has its own cycle, we're able to look across those cycles and say, okay, look at the copper. The valuations are very rich at the moment. It's a crowded trade. We're not going to invest in that sector right now, but we'll invest in the precious metals. That will turn in a year's time. It will be vice versa. Copper, nobody wants because we've gone into a recession. Supply is exceeding demand. Prices are lower. And that's where you want to invest. And we've done that with uranium. We were in uranium a couple of years ago. The uranium equities have come back a long way. We're now starting to get interested in uranium. So that's how, rather than stick by that one commodity up and down, you look at the valuations and where the best value is. And that will dictate the makeup of the portfolio.
My thanks to George, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on our website, which is ii.co.uk. And I'll see you next week.